Most investors overcomplicate their portfolios and it usually costs them money. So in 2026, I'm running an experiment. I'm going to invest in 5 ETFs. Now, the good news is if we make money through this portfolio, it will go to charity at the end of the year. If it loses money, then I'll just cop the loss on the chin. This experiment isn't because I think I can beat the market. It's actually quite the opposite. It's to prove a point. My hypothesis being that complexity, i.e. adding in more funds to your portfolio, usually doesn't pay off in terms of higher returns. Okay, so these are the details. I've invested 500 real great British pounds into these 5 ETFs. There's a couple of spicy picks in there. £100 in each. I'm doing this on Trading 2 on 2 and I'm using their pie feature. If this portfolio makes money, the profits go to charity at the end of the year. If it loses money, it's my own money, so I'll take the loss. What else? No rebalancing. I'll let the winners run. All dividends we get will be reinvested back into the portfolio. And how is success judged? By benchmarking the return of this portfolio against the return of the Vanguard FTSE All World. I'm pretty excited for this one. It's the first time I've done something like this. I find it really interesting as there's a few storylines in this experiment specifically. Will the UK market beat the US 2 years running? Will Europe continue to recover? India, where so much growth is happening, was one of the worst performing stock markets in 2025. Will it rebound? As I mentioned, I'm going to be running this experiment on Trading 2 on 2. All of the ETFs we're about to run through and break down are available on their platform. If you would like to sign up and get a free fractional share worth up to £100, you can by using the link in the description or use promo code MMS in the app or scan this QR code on screen. I know we're getting fancy with it. This actually took me about 30 seconds to make, but it does look quite professional, doesn't it? This is an affiliate link. A massive thank you to anyone who decides to use it. And also a massive thanks to Trading 2 on 2 for sponsoring this 2026 experiment. Let's run through the ETFs and I'll tell you my exact selection criteria for each one. Firstly, the US, and I'm going to put my money on that you don't know which ETF I'll be using. In terms of the index, this is the easiest one. I've chosen the S&P 500, tracking the largest 500 companies in the US. If you've read anything on investing, you would have probably come across this. And the S&P 500 accounts for roughly 80% of the total US stock market. Now, this is a competitive category as there are so many low-cost S&P 500 ETFs. There are 2 joint low-fee options, both with an ongoing fee of 0.03%. State Street's SPXL and UBS's S5UA. I went with the UBS version. If you did know this one, then fair play. It's a new ETF from 2025, so I thought most people wouldn't. Secondly, the UK. This one, of course, is close to my heart, and I'm picking an unconventional index. There are a few indexes or indices we could track. Most people choose the FTSE 100, but I've gone with the most diversified UK index, the FTSE All Share. This includes the FTSE 100, which is the largest 100 UK companies, the FTSE 250, which is the next largest 250 UK companies. These are essentially mid-cap UK stocks, and it also includes small companies. So the FTSE All Share covers 98% of the UK market, so it's truly a diversified UK fund. The issue is then finding an ETF that tracks this index. There aren't many available, but State Street offers FTAL, and luckily for a low fee of 0.2%. So I've gone with this one. This includes over 500 UK companies. Here is the sector breakdown on screen, and here are the top companies. The top 10 holdings actually make up over 40% of the ETF, so it is pretty concentrated. I'm pretty excited about this pick and this ETF. It's already performing well in 2026. Third, time to go, Mr. Worldwide. Let's talk global. This is the one income fund in the portfolio, so dividends will be paid out as cash and I will manually reinvest them, whereas with the other 4 funds, they're all accumulation, so the reinvestment will be done automatically. There are a lot of great global ETFs on the market. Fees have come down massively in this category in recent years. I've decided to go the lowest fee global ETF, and you're probably seeing a theme here, PACW or PACW. The ongoing fee is just 0.07%, which is tiny, especially when you consider it invests into over 3,500 companies globally. The ETF is provided by Amundi and a specific index it tracks. And here comes a Harry Potter spell, so be careful, I might cause that chair to start floating in the corner of your room. The selective GBS Global Markets large and mid cap. This index is provided by Solactive rather than by FTSE or MSCI. Solactive's licensing fees are much cheaper, meaning Amundi can offer a fund that tracks this index at a much lower ongoing fee. That's our global fund, and £100 is going into PACW. Fourth, Europe. This one might sound boring, but it's actually an interesting one. I mean, look at the recent returns from European stocks. There are a few different European indexes that we can invest into. I wanted the maximum diversification for the lowest fee, which brought me to this ETF, MEUD. This is also provided by Amundi and invests into over 600 European stocks for a very low fee of 0.07%. Now, I know what you're thinking. There is some overlap here with the UK ETF, but I mean, you can't have it all. And that's ultimately why global funds exist, so we can invest without any overlap. These are the top countries, so we do have some exposure to other major European markets. Here are the top sectors. You'll see a theme that European ETFs don't have as much tech exposure as the US market, which is partly the reason why European stocks have been lagging behind in recent years. And the top companies, much less concentrated than some of the other ETFs we've been through, with the top company being a semiconductor stock. European stocks had a great 2025 as investors allocated money away from the US and towards other markets. So let's see if that keeps up in 2026, hopefully for the sake of this ETF pick in the portfolio. Fifth and finally, the spiciest of them all, the spiciest until last, an Indian ETF. India was one of the worst performing stock markets in 2025, yet there is so much potential and growth in that country, which is why I wanted to include it in this 5-fund portfolio for this experiment. Once again, there are a few different indexes that we can track. And once again, I wanted the maximum diversification for the lowest fee, so I went with the FTSE India 3018 capped index. Now, this is a really interesting index. There's only one ETF available, and it's provided by a fund manager that I wasn't aware of before called Franklin. And that's the beauty of research, always finding out new stuff. This index tracks over 250 Indian companies. It is the most diversified Indian ETF option for a low fee of 0.19%. Some Indian ETFs, in fact, the largest one here from iShares, had a fee of over 0.5%. The iShares ETF tracks a slightly different Indian index, so the underlying holdings are a little bit different. As you can see, the performance is very similar, and this iShares ETF has a massive fee, relatively speaking. So I picked the Franklin India ETF, which is the only ETF that tracks this very interesting FTSE India 3018 capped index. What does this mean? The largest company in the index is limited to a maximum of 30% of the index capitalization, and all other index components to a maximum of 18%. These are the top sectors in the Indian market, as you can see on screen, and these are the top companies dominated by banks and financial companies. They are the 5 ETFs, and these are how they look in my trading 212 pie. This portfolio gives me global diversification with ultimately more weighting towards the UK, the US, and India. If those countries perform well, particularly the UK and India, then I should make some nice gains and outperform a FTSE All World fund. Time will tell. It honestly was really fun researching these ETFs, going down a rabbit hole and seeing which indexes I wanted to track and which ETFs I wanted to invest in. I'll check back in on the performance of this portfolio on here on YouTube and give you a mid-year update to let you know how it's getting on. Let me know what you think of this experiment down below in the comments, and let me know what ETF you think is going to perform best in 2026. And if you do want to sign up to Trading 212 and get a free fractional share worth up to £100, check out the link in the description. I'll actually flash up the QR code again on the screen, and I know honestly we are really getting fancy with it, and the production quality is going from strength to strength on this channel. But thanks for watching, and I'll see you in the next video.